How Countries Go Broke, Chapter 2. The following is an excerpt from an early draft from Ray Dalio's new book, How Countries Go Broke, which is available for pre-order on the link in the description. This summary is brought to you by Mr. Mentorpreneur. Please like and subscribe. How Countries Go Broke, Chapter 2. Chapter 2. The Mechanics in Words and Concepts. Note, this chapter gives unconventional concepts about the mechanics of how markets work that I believe would be valuable for professionals and aspiring professionals, but are probably beyond the interests of others. I suggest that you give it a try to see whether or not it's the sort of thing you'd like to get into.
Because everything that happens has reasons that make it happen, it appears to me that everything changes like a perpetual motion machine. To understand this machine, one needs to understand its mechanics, and because everything affects everything else, these mechanics are very complex. As a result of breakthroughs in artificial intelligence, I believe that we are on the brink of almost understanding it all. But for now, we have to labor along the old-fashioned way, with people studying what happened using contemporary computers to aid them. That's how I created this description of the mechanics of the debt, credit, money, economic dynamic, which is, of course, only one big part of the greater dynamic. In my feeble attempts to understand and describe the most important mechanics that change the world as we know it, I do these in-depth studies, and then try to create more simplified explanations of them. Keep in mind that this is a very simplified picture. Zooming out to the highest level, the 5 most important drivers of change that are important to understand are the debt, credit, money, economic cycle, the internal political order, disorder cycle, the external geopolitical order, disorder cycle, acts of nature, droughts, floods, and pandemics, human inventiveness, most importantly, of new technologies. These are the biggest forces that affect each other to shape the biggest things that happen. If you want to understand what I learned from experiencing and studying them in a more complete way than I can cover in this study, you can read about them in my book, Principles for Dealing with the Changing World Order. In this study, we are going to examine the first of those, the credit, debt, money, economic dynamic, focusing most intensely on the late part of the longer-term debt cycle, when central governments and central banks go broke. I will start by A, walking you through some mechanics of how market prices are determined, and then B, looking at how the long-term debt cycle works. With that as a background, I will then turn to C, the archetypical sequence that leads to a country hitting the limits of debt and money and central banks and central governments going broke. At the same time, we will be exploring the other 4 forces, because the interactions of these 5 forces cannot be overlooked in observing the resulting overall big cycle. From what I can see, we are likely entering the very turbulent stage in the overall big cycle, driven by the interactions of these 5 big forces, and the resulting changes in the world order will be big. I hope this study can contribute to a better understanding of the dynamics and better decision-making to produce the best outcome possible. How the machine works. To me, money and credit are the lifeblood of the economy. They circulate nutrients, i.e., spending power, from the parts of the system that have excess amounts of it to the parts of the system that can best use it. The central government is like the brain that directs how the system works while also taking in and using some of the money and credit, typically about 15–30% of it, to perform its functions, e.g., providing for social programs, defense, etc. The central bank is like the heart that produces and pumps money and credit through the system. If the exchanges go well, and those who get capital use it productively, then the providers of capital, the users of it, and the economic system as a whole all prosper. If they don't, the system will become ill and experience trauma. To be clear, viewing the debt dynamic as a cyclical, perpetual motion machine working in essentially the same way through time and across countries doesn't mean that there are not changes over time and differences between countries. It's just that these changes are comparatively unimportant in relation to the timeless and universal mechanics and principles that are far less well understood than they should be. To me, it's invaluable to first see these timeless and universal principles of how the machine works, and then focus on the differences and what they are due to, because this approach provides a richer understanding of the cause-effect relationships. For that reason, I will start with these most important, timeless and universal mechanics and principles. To convey them in brief, I will explain just the major ones in a big picture, simplified way, rather than a detailed and precise way. In this big picture, simplified model, the following describes the major parts and major players and how they operate together to make the machine work. The 5 major parts and how they work. There are 5 major parts of the economic system that make up my simplified model of the machine. They are goods, services, and investment assets, money used to buy these things, credit issued to buy these things, debt liabilities that are created when purchases are made with credit, and debt assets, i.e., deposits and bonds, which, since one person's liabilities are another's assets, are the other side of the debt liabilities. If you can understand the transactions that occur as being made up of these 5 major parts, you can pretty much understand why there are big debt and economic cycles. To start, I will walk through how I think about transactions and some other important baseline mechanics. As mentioned, goods, services, and investment assets can be bought with either money or credit. Money, unlike credit, settles transactions. For example, if you buy a car with money, after the transaction, you're both done. What has constituted money has changed throughout history and across currencies. For long periods of history, money was a promise to deliver a certain amount of gold or other hard asset. In fiat monetary systems, which we've been in since the U.S. left the gold standard in 1971, money is what central banks print and is more like a form of credit, in that it is a promise to deliver buying power, not an actual hard asset. But money is different from credit as, at this time, it can only be created by central banks, and can be created in whatever amounts the central banks choose to create. Credit, unlike money, leaves a lingering obligation to pay, and it can be created by mutual agreement of any willing parties. Credit produces buying power that didn't exist before, without necessarily creating money. It allows borrowers to spend more than they earn, which pushes up the demand and prices for what is being bought over the near term, while creating debt that, over the longer term, requires the borrowers, who are now debtors, to spend less than they earn as they pay back their debts. This reduces demand and prices in the future, which contributes to the cyclicality of the system. Because debt is the promise to deliver money, and central banks determine the amount of money in existence. Central banks have a lot of power. Though not exactly proportional, the more money that is in existence, the more credit and spending there can be. The less money in existence, the less credit and spending there can be. Now let's look at how prices are set. To explain my approach for understanding how prices are set, which is different from the conventional economist's approach, I need to start at the most basic building block for understanding all markets and economics, which is the transaction. All markets and all economics are simply the aggregates of the transactions that make them up, and a transaction is simply the buyer giving money or credit to a seller, and the seller giving a good, a service, or a financial asset to the buyer in exchange. The price in a transaction equals the amount of money point credit the buyer gives, divided by the quantity of whatever the seller gives in that transaction, and a market is the aggregate of those transactions. For example, a transaction to buy wheat occurs when a buyer gives a certain amount of total money to a seller in exchange for a certain quantity of wheat, And a market consists of all the buyers and sellers making exchanges for the same things. E.g., the wheat market consists of different people, making different transactions for different reasons over time. And these many exchanges are what determine the price. So, price, P, was the amount spent on something, Qiwao, the total quantity of it that is sold, Q. Or, more simply, P, Xinguang, Q. In other words, since the price of any good, service, or financial asset equals the total amount spent by buyers, TBI, divided by the total quantity sold by sellers, Q. If you know total spending, total dollars, and you know the total quantity sold, total Q, you will know the price and everything else you need to know. That is indisputably how it is. So it is indisputable that the best way to estimate the price is to estimate the total spending and divide it by the total quantity sold. And what is the best way to estimate these things? It is to understand the motivations of the buyers and sellers. All buyers have their own reasons for spending the amounts of money that they are spending to get the quantity they are buying. And all sellers have their own reasons for selling the quantity they are selling to get the money they're getting. What I'm saying is conveyed in the conceptual diagram below. While this might look and sound complicated, it's really not. For each product, the buyers and sellers have their reasons for making those purchases and sales, and it's pretty easy to determine who the main buyers and sellers are and what motivates them. If you can figure out major buyers' reasons for spending and you know the major sellers' reasons for selling, you can pretty accurately predict their actions and thus the price. This way of looking at price determination is very different from how most economists look at it. The traditional way measures both demand and supply in terms of quantity, i.e., quantity bought and quantity sold, where my approach looks at amounts spent to buy instead of quantity bought. This leads to different ways of explaining why prices change. The conventional approach describes price changes as occurring because the quantity demanded and/or the quantity supplied changes. How these changes occur is called price elasticity. This way of looking at the market implies that there is one elasticity of demand and one elasticity of supply, and different theories emerge about how the market digests information. I don't think that approach makes sense because it assumes that a change in supply will always have the same effect on price, i.e., elasticity, which isn't true. For example, if more money is spent on a product because buyers have more money to spend, the price of that product will be higher. Ultimately, if your goal is to understand and predict price movements, you are much better off trying to connect who is doing what in the market with how prices are changing. I started doing this as a commodities trader back in the 1970s and found that not only did this approach work better for me than more conventional approaches, it could also apply to all kinds of products and assets, including financial ones. In fact, I use this template to model not just how specific markets work, but entire economies. But that's a subject for another time. If you play with the previously shown formula model a bit, you will see that prices change when there are changes in the rates of spending and/or quantities sold. For example, if the rate of buying goes from X to X minus 10%, and all else stays the same, the price will fall by 10%. So, if you identify rates of unsustainable buying and/or rates of unsustainable selling, you can identify price and economic reversals ahead of them occurring. And if you calculate what a return to a more normal level of buying or selling is, you can calculate the approximate price change that is needed and likely. There are a number of other implications for how this different approach leads to unique perspectives on how economies and markets work. But the most important one for understanding short-term market and economic cycles is that it shows how these cycles are driven more by creations of money and credit that lead to changes in spending, S, than by the changes in the quantity sold, Q, because most goods, services, and investment assets are produced to satisfy demand, i.e., in response to S. I also see that when A, more money and credit are created, so there is more spending, and B, producers have the capacity to produce more quantity, then C, there can be more non-inflationary growth because both spending, SPO, and the quantity, Q, sold increase. Whereas, when A, more money and credit are created, so there is more spending, but B, there is little or no capacity, so producers can't produce much more, then C, there is little real growth and a lot more inflation. These principles explain why the early cycle, when there is plenty of excess capacity and central banks are stimulative, is characterized by strong growth and little inflation, and the late cycle typically has weak growth and big price rises. That is what cyclical inflation and growth look like. Later in this study, we will go through this in more detail and explore what monetary inflations and inflationary depressions look like. How does productivity fit into the above? If productivity growth is high, producers can produce more quantity, Q, as more money and credit are produced, so it allows non-inflationary growth to continue for longer. Of course, productivity can be hard to measure directly, as productivity can also show up as products improving in quality, or the marginal cost of producing something falling all the way to zero, as has happened for producing photos and electronic books. Now let's look more closely at the reasons buyers spend and sellers sell the quantities they sell. Instead of doing that for all the individual items, I will look at the big categories to convey the principles that affect them all. People buy goods and services to use, and they buy investments to make money, i.e., as storeholds of wealth. How much they spend on goods and services versus investments depends on what the goods and services they want to use cost relative to the amount of money and credit they have to spend, and the relative appeal of spending on goods and services to that of spending on financial assets. And of course, they have their own reasons for choosing which goods and services and which financial assets they buy. What people choose to spend their money and credit on is based on the relative appeal of the items. People are constantly making comparisons in two dimensions. One item for another, e.g., money for corn, gold, currency, just about everything else, and two, the same item for delivery at different points in time, e.g., corn, gold, currency for delivery today versus for delivery a year in the future, based on their preferences. As a result, there is an enormous array of relative appeal assessments to be made. Arbitrages and relatively sure bets are the most powerful types of bets in determining relative pricing. Currencies are mediums of exchange and storeholds of wealth in debt assets. In other words, they facilitate both transactions and investing. Investments are exchanges of money and credit today for money and credit in the future. All investment markets derive their value by providing money in two ways, through their yields and through their price changes. Together, they make the total return. So, for all investments, total return, yield plus price change. By and large, all investment markets compete with each other on the basis of the total returns they provide. That is because A, most investors care more about the total returns they get than they care about whether it comes in the form of yield or price appreciation. And B, there is an ability to arbitrage investments based on their total returns. To show how that works, let's look at how investing in bonds would be compared with investing in gold to determine the price relationship. Because gold has no yield and a U.S. Treasury bond has a yield of X%, e.g., 5%, it would be illogical for anyone to buy gold unless the price is expected to go up by more than X% per year, e.g., 5% per year. Said differently, the market is priced for the gold price to rise by 5% relative to the price of treasuries. Investors form their views about what will determine the gold price change, e.g., one big factor is the amount of inflation based on the amount of money and credit that is produced, and they look at the relative attractiveness of the 5% yield that the bonds are offering and the extent the gold price would appreciate due to the depreciation in the value of money. If they think that gold will rise by less than 5%, they can buy bonds and sell gold. And if they think gold will go up more than 5%, they can do the reverse. In either case, they'll make money if they're right. On top of this simple price analysis, there is a lot of financial engineering, e.g., leveraging and hedging, that turns one thing into the equivalent of another to make relative value bets and arbitrages that create a whole matrix of market prices. An enormous amount of money is allocated in this way, and it would be easy to make a lot of money if the choices between options were easy. But because we know it's not easy to make money in the markets, we can assume that the markets do a pretty good job of making these estimates and pricing assets correctly. At the same time, because I and others who have been successful at investing couldn't have been successful at investing if the markets were perfect, we can assume that it's not perfectly done and there are opportunities to make money in the markets if you have a better understanding than others. Anyway, my main point is that this is how to determine how markets are priced, which you will soon see is helpful in understanding the debt, credit, money, economic dynamic. The expected rates of return on investment assets relative to the rate of inflation, i.e., the expected real returns of investments, will influence how much money goes into each of these. By and large, an investment's inflation-adjusted real returns are more important than its non-inflation, or i.e., nominal, returns, because a. investments are made to be storeholds of wealth, so buying power matters most, and b. there are arbitrages and relative value bets between real assets and financial assets that drive their relative prices. In other words, the expected returns of putting money into financial investments are compared with the expected returns of putting money into real stuff, e.g., real estate, precious metals, commodities, art, etc. So the returns of all investments, especially the returns of government bonds. Because their returns are so well known, since the yield is set, and there is virtually no risk of default for bonds denominated in a country's own currency, are compared with the inflation rate. So when bond yields are low relative to inflation, bonds will be sold and inflation assets will be bought, and vice versa. Also, because the decline in the value of money and credit that arises from central banks, creating lots of both, causes the prices of goods, services, and most financial assets to rise. When central banks create a lot of money and credit, that tends to lead investors to favor inflation hedge assets. Prices are linked by certain determinants that one must understand to understand relative pricing. When most non-professional investors think about the price, they usually think about the price for delivery of the item today, which is called the spot price. Most markets also have prices for deliveries sometime in the future, which are called forward or futures prices, and there are arbitrages or relative value bets that one can take that determine the price relationship of the same items at different delivery dates. The same sort of analysis of the relative appeal of the same financial assets, e.g., short-term government debt and long-term government debt, takes place, e.g., a big factor determining that is the projected pace at which the central bank will increase or decrease interest rates. Debt is currency, and currency is debt. Since a debt asset is the promise to receive a specified amount of currency at a future date, debt and currency are essentially the same things. If you don't like the currency, you must not like the debt asset, e.g. bonds. And if you don't like the bonds, you must not like the currency, if you take into consideration their relative yields. In other words, if you don't like one, you must not like the other. Remember the gold bond price comparison process described earlier of looking at the relative yields plus the expected price changes, the relative total returns. This sets the spot and futures prices for bonds and gold, and it works the same for assessing the value of different currencies and different debt assets of different countries. That assessment drives capital flows in important ways that are very relevant to the debt issue at hand. More specifically, let's say the government interest rate, which is widely considered default risk-free because government central banks can print money to make payments, in one country, e.g., Japan, is below that in another country by X% per year. If that's the case, then the expected appreciation in that currency must be at the same percentage rate. Otherwise, it would be easy to make virtually risk-free profits by owning the bonds with the higher interest rate. Instead, the difference in the interest rates is expected to be eaten up by the higher interest rate currency falling compared to the lower interest rate currency. But what if that currency change is not expected to offset the interest rate difference? For example, if the 10-year interest rate in country A is lower, e.g., 3% lower, than that in country B's currency-denominated bond, you'd ordinarily expect country A's currency to rise, to eat up the difference from the higher interest rate. What if, instead, country A's currency is expected to fall, e.g., by 2% per year? In that case, there is virtually risk-free profit to be made. Investors will flock into the trade, selling the lower-yielding currency charged debt. That will produce one of two adjustments, or a combination. A. The spot currency will have to fall by 40% in this example, or B. The 10-year interest rate will have to rise by 5%, which will send the bond prices down by about 40%. Or if those adjustments can't happen, say there are capital controls or the like, if the interest stays 3% less and the currency falls by 2%, then the loss relative to holding country B's bonds will be 5% per year, which over the 10 years will compound to 40%. Any way you cut it, the bond return in country A's currency will be very bad. If the nominal bond returns are not bad, i.e., the bonds do not depreciate and debt burdens are not reduced in nominal terms, because neither A, the price of the bonds falls in the local currency because the interest rates rise to provide an appropriate return in light of the declining value of the currency, nor B, the currency declines to a level that makes it cheap enough to provide adequate price appreciation to make up for the interest rates being too low. Then the bad return of the bond will come about, because C, the annual interest rate and weakness in the currency, will not compensate for the inflation. Now that we understand how the mechanics of these major parts work, and how transactions are driven by the motivations of players in dealing with those parts, you will understand how the machine works and what is likely to happen next. So let's get into that. The major types of players and how they behave to drive what happens. 5 major types of players drive money and debt cycles. They are those that borrow and become debtors that I call borrower debtors, which can be private or government entities. Those that lend and become creditors that I call lender creditors, which can be private or government entities. Those that intermediate the money and credit transactions between the lender creditors and the borrower debtors, which are commonly called banks, central governments, and government-controlled central banks, which can create money and credit in the country's currency and influence the cost of money and credit. Credit debt expansions can only take place when both borrower debtors and lender creditors are willing to borrow and lend, so the deal must be good for both. Said differently, because one person's debts are another's assets, for the system to work, it takes both borrower debtors and lender creditors to want to enter into these transactions. However, what is good for one is quite often bad for the other. For example, for borrower debtors to do well, interest rates can't be too high, While for lender creditors to do well, interest rates can't be too low. If interest rates are too high for borrower debtors, they will have to slash spending or sell assets to service their debts, or they might not be able to pay them back, which will lead markets and the economy to fall. At the same time, if interest rates are too low to compensate lender creditors, they won't lend and will sell their debt assets, causing interest rates to rise or central banks to print a lot of money and buy debt in an attempt to hold interest rates down. This printing of money, buying of debt, will create inflation, causing a contraction in wealth and economic activity. Over time, environments shift between those that are good and bad for lender creditors and borrower debtors. To be effective, it is critical that anyone who is involved in any way in markets and economies knows how to tell the difference. This balancing act and the swings between the two environments take place naturally, and sometimes conditions make it impossible to achieve a good balance. That causes big debt, market, and economic risks. Before I describe the conditions that produce these risks, I want to first explain the other players' motivations and how they try to act on them. Private sector banks are the intermediaries between lender creditors and borrower debtors, so their motivations and how they work are important too. In all countries for thousands of years, banks have done essentially the same thing, which is to try to make profits by borrowing money from some and lending it to others, earning money on the spread. How they do this creates the money-credit-debt cycles, most importantly, the unsustainable bubbles and big debt crises. How are these bubbles and crises created? By the banks lending out a lot more money than they have, which they do by repeatedly borrowing at a cost that is lower than the return they take in from lending. That works well for the society and is profitable for the banks when those who are lent money use it productively enough to pay back their loans, and when those the banks borrowed from don't want their money back in amounts that are greater than what the banks actually have. But debt crises happen when the loans aren't adequately paid back, or when the bank's creditors want to get more of the money they lent to the banks than the banks are able to give them. Over the long run, debts can't rise faster than the incomes that are needed to service them, and interest rates can't be too high for borrower debtors or too low for lender creditors for very long. If debts keep rising faster than incomes, and/or interest rates are too high for borrower debtors or too low for lender creditors for too long, the imbalance will cause a big market and economic crisis. For that reason, it pays to watch these ratios. Big debt crises come about when the amounts of debt assets and debt liabilities become too large relative to the amount of money in existence and/or the amounts of goods and services in existence. Central banks either directly or indirectly create money and credit, which is buying power. Buying power determines the total amount of spending on goods, services, and investment assets. Whatever amount of money and credit is created must be put into goods, services, and/or financial assets, i.e. investments. So, the total amount of money and credit created determines the total amount of spending on goods, services, and financial assets. As a result, goods, services, and financial assets tend to rise and decline together with the ebbs and flows of money and credit. Like all boats tend to rise and fall with the ebbs and flows of the sea. What this money and credit go into, and the quantities of goods, services, and financial assets that are produced, are mostly determined by the choices made by thousands or millions of market participants. Central banks came into existence to smooth these cycles, most importantly by handling big debt crises. Until relatively recently, e.g. 1913 in the United States, there weren't central banks in most countries, and money that was in private banks was typically either physical gold or silver, or paper, certificates to get gold and silver. Throughout these times, there were boom-bust cycles because borrower debtors, lender creditors, and banks went through the credit debt cycles I just described. These cycles turned into big debt and economic busts when too many debt assets and liabilities led to lender-creditor runs to get money from borrower debtors, most importantly, the banks. These runs produced debt market economic collapses that eventually led governments to create central banks to lend money to banks and others when these big debt crises happened. Central banks can also smooth the cycles by varying interest rates and the amount of money and credit in the system to change the behaviors of borrower debtors and lender creditors. Where do central banks get their money from? They print it, literally and digitally, which, when done in large amounts, alleviates the debt problems because it provides money and credit to those who desperately need it and wouldn't have had it otherwise. But doing so also reduces the buying power of money and debt assets and raises inflation from what it would have been. Central banks want to keep debt and economic growth and inflation at acceptable levels. In other words, they don't want debt and demand to grow much faster or slower than is sustainable. And they don't want inflation to be so high or so low that it is harmful. To influence these things, they raise interest rates and tighten the availability of money, or they lower interest rates and ease the availability of money, which influences lender creditors and borrower debtors who are striving to be profitable. Central governments are political organizations with those who run them serving at the pleasure of the people, so they want to give the people what they want. This is typically done without paying for it, which typically leads to central government borrowing, which reinforces the cycle of creating greater amounts of credit stimulation early and debt depressants later. When central governments do their jobs well, they tax and spend in ways that make broad-based productivity and prosperity, sometimes borrowing more than they are earning and sometimes paying it back. And when central banks do their jobs well, they keep the credit, debt, and capital markets in relative balance, which produces less disruptive big swings. However, for the previously mentioned reasons, the bias to create more ups in the economies and markets through credit stimulation leads to long-term uptrends in debt and debt service relative to incomes until they become too large a percentage of income to be sustainable. The greater the size of the debt assets and debt liabilities relative to the real incomes being produced, the more difficult the balancing act is, so the greater the likelihood of a debt-caused downturn in the markets and economy. Because borrower debtors, lender creditors, banks, central governments, and central banks are the biggest players and drivers of these cycles, and because they each have obvious incentives affecting their behaviors, it is pretty easy to anticipate what they are likely to do and what is likely to happen next. When debt growth is slow, economies are weak, and inflation is low, central bankers will lower interest rates and create more money and credit, which will incentivize more borrowing and spending on goods, services, and investment assets, which will drive the markets for these things and the economy up. At such times, it is good to be a borrower-debtor and bad to be a lender-creditor. When debt growth and economic growth are unsustainably fast and inflation is unacceptably high, central bankers will raise interest rates and limit money and credit, which will incentivize more saving and less spending on goods, services, and investment assets. This will drive the markets and economy down because it's then better to be a lender-creditor-saver than a borrower-debtor-spender. This dynamic leads to two interrelated cycles. A short-term one that has averaged about 6 years in length, give or take 3 years, and a long-term one that has averaged about 80 years, give or take 25 years, which evolve around an upward trend line in productivity that is due to humanity's inventiveness. I'll now briefly review how these cycles transpire. The short and long-term big debt cycles. By short-term debt cycle, I mean the cycle of 1, recessions that lead to 2, central banks providing a lot of credit cheaply, which creates a lot of debt that initially leads to 3, market and economic booms that lead to 4, bubbles and inflations, which lead to 5, central bankers tightening credit, which leads to 6, market and economic weakening. This cycle typically lasts about 6 years, give or take about 3. As of this writing, there have been 12.5 of these in the U.S. since 1945, i.e., at the time of my writing, we are about halfway through the 13th. Each short-term debt cycle typically ends with higher levels of debt than the previous cycle because policymakers try to end recessions by lowering interest rates enough to get borrowing going again. By long-term, big debt cycle, I mean the cycle of building up debt assets and debt liabilities over long periods of time, i.e., successive short-term debt cycles, to amounts that eventually become unmanageable. This leads to a combination of big debt restructurings and big debt monetizations that produce a period of big market and economic turbulence. The short-term debt cycles add up to the long-term, big debt cycles, which I will henceforth call the big debt cycle. These cycles move markets and economies around an upward-sloping trend line of rising living standards that is due to people's inventiveness and the increases in productivity that come from it. The incline of its upward slope in productivity is primarily driven by the inventiveness of practical people, e.g., entrepreneurs, who are given adequate resources, e.g., capital, and work well with others, their co-workers, government officials, lawyers, etc., to make productivity improvements. Over a short period of time, i.e., 1 to 10 years, the short-term debt cycle is dominant. Over a long period of time, i.e., 10 years and beyond, the long-term debt cycle and the upward-sloping trend line in productivity have much bigger effects. Conceptually, the way this dynamic transpires looks like this to me.
What separates a sustainable debt cycle from an unsustainable one is whether the debt creates enough income or more to pay for the debt service. If incomes fail to grow as quickly as debt and debt service, the ratio of debts to incomes will mechanically grow, which will require increased borrowing to serve debt as well as to spend. The cycle goes from low to high to unsustainably high debt and debt service relative to incomes. A sure sign of moving toward a debt crisis is when there is a large and rising amount of borrowing that is being used to pay for the debt service. Why don't central bankers do a better job than they have been doing in smoothing out these debt cycles by better containing debt so it doesn't reach dangerous levels? There are 4 reasons. Most everyone, including central bankers, wants the markets and economy to go up because that's rewarding and they don't worry much about the pain of paying back debts. So they push the limits, including becoming leveraged to long assets until that can't continue, because they have reached the point that debts are so burdensome they have to be restructured to be reduced relative to incomes. It is not clear exactly what risky debt levels are because it's not clear what will happen that will determine future incomes. There are opportunity costs and risks to not providing credit that creates debt. Debt crises, even big ones, can usually be managed to reduce the pain they cause to acceptable levels. Debt isn't always bad, even when it's not economic. Too little credit debt growth can create economic problems as bad or worse than too much, with the costs coming in the form of foregone opportunities. That is because 1, credit can be used to create great improvements that aren't profitable that would have been foregone without it, and 2, the losses from the debt problems can be spread out to be not intolerably painful if the government is in control of the debt restructuring process, and the debt is in the currency that the central bank can print. However, to avoid a debt crisis, debt must raise incomes to service the debts. Over time, from one cycle to the next, debt liabilities and debt assets have virtually always increased to make the long-term debt cycle expansion. In virtually all cases that has continued until the debt burdens have become unsustainably large, or the debt assets have become intolerably low returning. When there are a lot of debt assets and debt liabilities relative to incomes, it is difficult for central bankers to keep interest rates high enough to satisfy lender creditors without having them so high that they unacceptably hurt borrower debtors, and it is difficult for central banks to run monetary policy to balance growth and inflation well. And because holders of debt assets want to sell the debt, one way or another, debt is going to have a bad return. That puts central bankers in the position of having to choose between not printing money and buying debt, i.e., not monetizing debt, and letting interest rates rise enough to cut credit demand and economic activity, enough to reach the indifference equilibrium level that will balance the buying and selling of the bonds. This will make cash very valuable, devalue most other assets like stocks and hard assets, cause deflation, lead to debt defaults and restructurings, and depress economic activity. This typically happens first and is intolerable, which leads to central banks to start printing money and buying debt, i.e., monetizing debt, to make up for the shortfall in demand, which will make money readily available and reduce its value, thus raising inflation, raise the value of most other assets like stocks and hard assets, minimize debt defaults, and stimulate economic activity. This typically eventually happens. At that part of the big debt cycle, there need to be big reductions in debt liabilities and debt assets. These are the big debt crisis periods. These big debt restructurings and debt monetizations end the prior big debt cycle by reducing debt burdens and eliminating the prior monetary order, leading to the next new big debt cycle and monetary order. They take place much like big changes in domestic political orders and big changes in world orders. Like seismic shifts due to the old orders breaking down. There are 4 types of levers that policymakers can pull to reduce the debt burdens. Austerity, i.e., spending less. Debt defaults, us restructurings. The central bank printing money and making purchases or providing guarantees. And transfers of money and credit from those who have more than they need to those who have less. Policymakers typically try austerity first because that's the obvious thing to do, and it's natural to want to let those who got themselves and others into trouble bear the costs. This is a big mistake. Austerity doesn't bring debt and income back into balance because one person's debts are another person's assets. Cutting debts cuts investors' assets and makes them poorer. And because one person's spending is another person's income, cutting spending cuts incomes. For that reason, cuts in debts and spending cause a commensurate cut in net worths and incomes, which is very painful. Also, as the economy contracts, government revenues typically fall at the same time as demands on the government increase, which leads deficits to increase. Seeking to be fiscally responsible at this point, governments tend to raise taxes, which is also a mistake because it further squeezes people and companies. More simply said, when there is spending that's greater than revenues and liquid liabilities that are greater than liquid assets, that produces the need to borrow and sell debt assets, which if there's not enough demand, will produce one kind of crisis, e.g., deflationary, or another, e.g., inflationary. As touched on earlier, the best way for policymakers to reduce debt burdens without causing a big economic crisis is to engineer what I call a beautiful deleveraging, which is when policymakers both 1. Restructure the debts so debt service payments are spread out over more time or disposed of, which is deflationary and depressing, and 2. Have central banks print money and buy debt, which is inflationary and stimulating. Doing these 2 things in balanced amounts spreads out and reduces debt burdens and produces nominal economic growth, inflation plus real growth, that is greater than nominal interest rates. So debt burdens fall relative to incomes. If done well, there is a balance between the deflationary and depressing reduction of debt payments and the inflationary and stimulating printing of money and buying of debt by the central banks. In the countries I studied, most big debt crises that occurred with the debts denominated in a country's own currency were restructured quickly, typically in 1 to 3 years. These restructuring periods are periods of great risk and opportunity. If you want to learn more about these periods and processes, they are explained more completely in Principles for Navigating Big Debt Crises. The big debt cycle, its risks, and how to deal with it need to be better understood, because the really big debt crises that take the form of debt restructurings and devaluations that come at the ends of big debt cycles happen roughly once in a lifetime. They are not well understood relative to the short-term cycles. That is why I did this study. Said differently, what ends long-term debt cycles is different from what ends short-term debt cycles, so most people don't know about or acknowledge long-term debt cycles, or worry about long-term debt cycles ending even though they're much bigger deals than short-term debt cycles ending. That's dangerous. It's like eating fatty foods and having cholesterol accumulate in the heart as plaque and saying that it doesn't seem to be causing trouble while it is increasing the probability of a heart attack. Let's remember what is healthy, which is 1. Having private sector lenders give their credit in exchange for debt that works well for them and creditors because the uses of the funds were profitable, and 2. For government borrowings to be used in ways that produce productivity gains, e.g., in better infrastructure, education, etc., that can be paid for via tax revenue, or for the government to sometimes borrow and spend more than it takes in when the economy needs stimulation that is followed by paying it back when conditions are strong. And let's remember what isn't healthy, which is 1. The central bank chronically printing money and buying debt to make up for the shortage in demand for the debt, and 2. The central government chronically having large deficits that result in debt and debt service levels rising faster than the incomes, in the government's case tax revenue, that are required to service them. In summary, and to reiterate, goods, services and investment assets can be produced, bought and sold with money and credit. Central banks can produce money and can influence the amount of credit in whatever quantities they want. Borrower debtors ultimately require enough money and low enough interest rates for them to be able to borrow and service their debts. Lender creditors require high enough interest rates and low enough default rates from the debtors in order for them to get adequate returns to lend and be creditors. This balancing act becomes progressively more difficult as the sizes of the debt assets and debt liabilities both increase relative to the incomes. Eventually, they need to be reduced, so a deleveraging happens. The best type of deleveraging is what I call a beautiful deleveraging, which can be engineered by central governments and central banks to reduce debt burdens if the debt is in their own currencies. If the debts are denominated in a foreign currency, the deleveraging is quite ugly. I will explain these later. Over the long term, being productive and having healthy income statements, i.e. earning more than one is spending, and healthy balance sheets, i.e. having more assets than liabilities, are the markers of financial health. If you know where in the credit debt cycle each country is and how the players are likely to behave, you should be able to navigate these cycles well. The past is prologue. Important takeaways. Debt crises are inevitable. Throughout history, only a very few well-disciplined countries have avoided debt crises. That's because lending is never done perfectly and is often done badly due to how the cycle affects people's psychology to produce bubbles and busts. Most debt crises, even big ones, can be managed well by economic policymakers if they are well spread out. All debt crises provide investment opportunities for investors if they understand how they work and have good principles for navigating them well. Inevitably, at the beginning of the end of the big debt cycle, when there is a lot of debt, it is difficult to keep real interest rates high enough to satisfy lender creditors without them being too high for borrower debtors, and central banks try to navigate between these choices. Typically, during these times, both the tight money economic contraction and the loose money inflation occur, and the only question is in what order. In any case, owning the debt currency of overly indebted governments at such times is a bad investment. Central banks have to choose between keeping money hard, which will lead debtors to default on their debts, which will lead to deflationary depressions, or making money soft by printing a lot of it, which will devalue both it and the debt. Because paying off debt with hard money causes such severe market and economic downturns, when faced with this choice, central banks always eventually choose to print and devalue money. For the case studies, see Part 2 of Principles for Navigating Big Debt Crises. Of course, each country's central bank can only print that country's money, which brings me to my next big point. If debts are denominated in a country's own currency, its central bank can and will print the money to alleviate the debt crisis. This allows them to manage it better than if they couldn't print the money, but of course it also reduces the value of the money. The other four big forces affect how this debt cycle transpires, just as this debt cycle affects how the other four forces transpire together. Thus far, I have just spoken about debt cycles because that is the subject of this study. However, many factors interact to determine what happens, so I couldn't ignore them and do my job well. They were covered extensively in my book Principles for Dealing with the Changing World Order. While I showed 18 measures of the major drivers of conditions in the book, The big five that explain almost everything are 1. The money, credit, debt, markets, economic cycles. 2. The cycle of social and political order and disorder that takes place within countries. 3. The cycle of order and disorder that is manifest in the peace and war cycle that takes place between countries. And 4. Acts of nature shocks such as droughts, floods, and pandemics. And 5. Human inventiveness, especially of new technologies that increase productivity. The interactions between these forces drive how conditions change. They tend to reinforce each other, both upwardly and downwardly. For example, periods of financial and economic crisis raise the odds of having periods of internal conflict, and periods of internal conflict worsen financial and economic conditions. Similarly, periods of internal financial problems and internal political conflicts both weaken the country that they are happening in, and if they are global, increase the likelihood of international conflicts. Together, these forces create the big cycles of ups and downs, peace and wars, that occur in countries and between countries, that lead to big changes in domestic and world orders. These big rises and declines are easy to see by monitoring the 18 forces, particularly the big five, that I'm sharing with you. For example, you can see the big evolutionary decline of great powers and their monies reflected in 1. The unwavering rises of indebtedness, accompanied by the steady weakening of the types of monetary systems used to restrain credit and debt growth-motivated attempts to raise credit and economic growth. And 2. The decline of many indicators of health, such as the quality of education, infrastructure, law and order, civility, government effectiveness, relative to those other world powers. I won't now delve into how all these work, both because doing that would be too much of a digression and because it's better explained in my book, or even in my relatively brief video, both titled Principles for Dealing with the Changing World Order. I will now delve into a description of the mechanics of the big debt cycle in numbers and equations, which I will try to describe in an easy-to-understand way. The views expressed in this article are those of the author Ray Dalio,